In this week's update, reversion to the mean is on in earnest. It's just the start for Nvidia and AI and the Trump impact on markets. My name's Garry Davis. As always, general advice only, and please remember to like and subscribe to the video. Start with our usual market perspective. There's been a lot written in the last 6 to 12 months since the price of Nvidia really took off about whether it was ridiculously overvalued and a big investor's trap. My assessment, as I've presented several times through not only this Sunday video, but also through separate individual videos about Nvidia, is it's really just getting started, and I don't see that anything at all has changed. And there is a significant life beyond just manufacturing semiconductor chips for Nvidia or GPUs. They are, when you really look into what the company's doing, they are positioned for the next technological waves. They're at the forefront of that. They're already building new computers targeted at the development of physical AI and robotics. So they're not going to be caught napping, I don't believe. And there's a reason that they're a market leader, and I don't think that that's going to change. The question has been arising recently whether some of their major customers would actually, rather than pay the very high prices, would they take on manufacture themselves? Look, it's an open question. Can and will the competition catch up? Nvidia's been dominant for more than a decade, and there's probably more reasons to expect that that'll continue rather than someone's going to come up and take over from them. So I think it's a pretty good probability that Nvidia is going to remain a leader. And when you look at the growth rates and when you look at the current valuation, there's absolutely no reason why the share price cannot continue its upward trend in the long term. Now, that doesn't mean it's necessarily a buy today, but when we look at the current value, and I'll do that in a minute when we get to the charts, I think it's easily justifiable. I don't think this is outrageously overpriced. In fact, in some metrics, you could even argue that it's perhaps a little undervalued given the growth. And the good news about what's happened in the last week with semiconductors getting really slammed is that sudden big moves almost always become irrational to a degree, and they create opportunity. So I think that's the situation that we've certainly got with Nvidia and with others. The American market, the S&P was down just a tick over 2%, but the Nasdaq was down 4% because of what happened in semiconductors. But on the plus side, the rotation into the smaller end of the market, which is way overdue, is still playing out. And if it wasn't for some marking down on Friday night, we would have seen even better results. For the equal weight S&P 500, the RSP, which is the ETF, was down just 0.1%, so almost flat. But the Russell was actually up 1.7, despite giving back a bit at the end of the week. So there's still a very robust rotation. A couple of things about that creates terrific opportunity in stocks that have been ignored and undervalued in the frenzy around AI and semiconductors. Secondly, there is a bigger picture reversion to the mean that is starting to play out, and it's likely that we're going to see significant gains in smaller stocks. Not all of them, but certainly in some of them, for a lengthy period of time. The valuation gap has been getting pointed to for probably since pre-COVID. There's been a huge valuation gap between large cap growth stocks and value stocks, between the S&P 500 and also the Russell 2000, and that valuation gap is the largest that it's been since 1999. So it doesn't guarantee that gap will get closed, but generally you find in finance there is a reversion to the mean at some point in time. No guarantees it's now, but it's certainly, if it's not now, it's hard to find a better justification just at the minute. And often these things, once they get started, they become self-fulfilling, particularly with the dynamics around how money flows into and out of ETFs. So I think there's a very, very good chance that the good small cap stocks in America and in Australia are going to get more tailwinds as they play catch up. So there's a terrific opportunity, I think. The US dollar index was a little bit lower. The yield was up strongly though, 4.24, and the VIX was up, jumped up from around 12.5 to 16.5. Let's go and look at some charts. We'll start with the S&P on a weekly chart. Look, it was down sharply, but you've got to remember the backdrop is it was options expiry, third week of the month. There was a massive amount of call premium, profits in call premium. There is certainly an advantage in some parts of the market being able to engineer a decline in some of those stocks. So what part did options expiry play? Look, it's impossible to put a number on it or a percentage, but I would be very, very surprised if there wasn't some form of influence there and that prices in some parts of the US market went down unnaturally, let's put it that way, and that we may well see a bounce back next week. So that was the S&P. There's the RSP. So it was going along quite well during the week, pulled back on Friday, but nevertheless still finished flat. But the Russell 2000 did manage to still put in a pretty good overall week. Now, if we look at the NASDAQ, very similar pattern to the S&P, but down about double in percentage terms. So much of it was about semiconductors. It was the comments made by both Biden and Trump with regard to the industry and Taiwan and China certainly helped that. But we'll just have to wait and see what happens in the first half of next week. Now, Nvidia is one that I want to take a look at. If you look at the actual price action around Nvidia, we got a big gap down on Wednesday. The volume jumped up a bit, but not ridiculously so. It wasn't like we were back here or back here. And then we actually got a bounce on Thursday, another little decline on Friday, but look at how the volume dropped away very suddenly. So I don't know whether Nvidia will continue to the downside and maybe get down under 100. I think if it does, it'll create an enormous opportunity, or whether it'll just hang around here for a bit and then just let some of this short-term excess value wash off. But the long-term, for me, looks very robust. And I just thought I'd share some numbers with you. They have a January accounting expiry. If we look at the growth in earnings from 2021 through to the projections through to 2027, you can see that the growth really took off in FY24. So that's January FY24. And the forecast, that's the current forecast for FY25. I do note that over the last 4 years that Nvidia has beaten the forecast quite comfortably. So there's every reason to expect that these numbers here for FY25 to 27 will actually prove to be a bit on the light side. But let's say they came in at that level, PE of 43 for year-on-year growth of 111%. Then it drops to 34 and then 18. Now, a couple of comments about this. Firstly, as you go out in the years, the analyst forecasts become more and more conservative because there's more unknowns. So that is natural. And also, as the company gets bigger and bigger, it's impossible to continue growing at these extremely high rates. So I'm not at all concerned by this year-on-year growth, because I think when we get there, the year-on-year growth, when you really look into the Nvidia business, is likely to be significantly more than this. But look, nevertheless, even on the surface, on these very conservative forecasts, to me, this is not expensive. Paying high 20 PEs, low 30 PEs is not a drama for a stock positioned as Nvidia is. So I just don't buy the valuation argument around Nvidia. Now, sure, it's not without risk, but everything you do in the market has some risk attached. It's a matter of the risk-adjusted return and also just having a plan that's suitable for you. You can do pretty much whatever you want in the market as long as you're very clear about what your plan is to deal with the risks and you're disciplined about it. So I don't see Nvidia as having a significant valuation problem. It would appear that we've got highly probable growth for years, decades to come. And when you understand what they're doing with robotics, I think you'd perhaps be as enthused as I am about it. So for me, it's just a matter of constructing a simple plan, be disciplined, let it unfold, be a little bit patient, but most importantly, do it in a way that's comfortable for your psychology, because different investors can accommodate different levels of volatility and risk. I think the absolute risk around stocks like Nvidia are very low over the next 2 to 5 years. But there certainly is volatility risk, that's for sure. So you've got to come up with a plan that just makes it easy on your psychology, because if you do something that you're not emotionally equipped to handle, it's going to fail because you're going to panic at exactly the wrong time. You're going to sell out when you should be buying, and you're going to be buying when you should be perhaps taking some profit. So just make sure that it's comfortable for your psychology. We deal a lot with this in the Insiders Club services. It's a pretty straightforward process, to be honest. It's just about clarity. And then you look beyond Nvidia. What about Taiwan Semiconductors? What about Google? What about Supermicro? All those stocks. So I think, notwithstanding what has happened in the last few days, which really isn't that ugly, to be honest, I think the media has made more of this than is actually there. And options expiry might prove that the whole thing was a bit contrived. So I think the outlook is fantastic. And if we look at Taiwan Semiconductors, for instance, and there's no recommendations, it's just an observation of the long term for this part of the market. So TSM was a little bit unfortunate because they released earnings on Thursday. They comfortably beat on revenue and earnings, top and bottom line, yet it all got swallowed up in the comments that were made and the panic selling. But if you look at the results, the valuation around TSM is still, I think it's the lowest of all of these tech majors. They've got earnings per share growth year on year of 36%. The forward PE is only 20 times. In my book, that makes them cheap, particularly when you've got very powerful tailwinds. The third quarter outlook was for similar sort of ongoing growth. The company was very positive, and they just got caught up in that chip sell-off last week. So there could be an opportunity brewing here. So the way that I look at a stock like TSM, and yes, there's risks around invasion of Taiwan, etc., but again, you can manage risk. You're not a victim of risk. Future higher prices look highly probable to me certainly over the longer term. I don't know what the short term is. Does this follow through down to 150, 160? No idea, and it doesn't really matter. To be honest, with the game plan that I've got around these stocks, I don't care. So what is the plan to milk that highly probable future upside, which could be quite significant? It's built around prudent risk management that fits with your psychology. And you just got to be honest with who you are as an investor. If you're not tolerant to a lot of volatility, then that's it. There's no issue with that. You've just got to recognize it and work to it. Because markets can be irrational. In the very short term, the price of TSM could go down significantly from here. And we could even end up way down here, somewhere near the 200-day moving average. I have no idea. But I feel highly confident about where it's going in the longer term, and so therefore you can build a plan around that. So there's a bit of insight into a couple of the tech majors. Semiconductor index versus the S&P, naturally it dropped, but there's nothing overly dramatic here. I'm not seeing anything that suggests that we're going to get a more protracted and deeper decline. I think it's likely that any consolidation is going to be relatively shallow and relatively short term. Still might run for a few weeks or a few months, but I don't think it's going to be anything terribly significant like what we saw in 2022. All right, there's the relative sector money flows in the US over the last month. Consumer discretionary came off. In fact, pretty much everything came off. Only healthcare really ticked up a little bit in the last week. Everything else was tracking down. And if we look at Australia, energy had quite a good run with the oil price being more buoyant, but terribly difficult sector, I find, to invest in Australia. And then finance, again, everything was heading in the downwards direction towards the end. So it'd be very interesting to see how our market starts up come next week. If we look at the currencies, there's the US dollar finished at 104.4, and if we look at the Australian dollar, we did come off towards the end as well and finished at 66.23. So just summarising, our market was up just a fraction, but I would assume that the Australian market will probably open lower on Monday and then take it from there. Certainly healthcare did well. They were very much the leader last week, and there were some pockets of good results for mining stocks as well. And in a number of cases, as you would hope and expect, the best supported mining stocks are the ones that have got the highly recognised astute management with great track records. And it's just such an important factor when you're investing in the mining sector to be going along with the most accomplished management teams that you can find. Now, the small cap index was actually down 1%, but there were some very powerful individual gains as well. So there's plenty of productive territory in the Australian market. Turning now to precious metals, gold had a real roller coaster. It was down $17, down to $23.95. So it's been pretty volatile the last week or two. In Australian dollars, it actually ticked up a little bit over the week, almost back to 3,600. And if you look at the gold market, there's a number of cross currents, probably a few more than normal. There is a bit of a recession on at the moment in jewelry demand and retail demand, particularly in China. And then we've got Trump trade policy, which I think is encouraging some central banks to be moving out of US bonds and into alternatives, one of which is gold. That has been running for a while, and I would expect that may actually accelerate now that it looks highly likely that Trump will win the election in November. If we look at precious metal stocks, they're broadly an uptrend, but they're still lagging quite badly on a relative basis. So there is still the facility for gold and silver stocks to play quite a bit of mean reversion catch-up. Let's go and look at the charts on precious metals. So we'll start with gold. This is a weekly chart, so you can see it has been a real roller coaster, and just looking at that on a daily. So we had very significant gains on Tuesday, bit of a pause on Wednesday, and then it was downhill, and particularly so on Friday. But again, I don't know what part options expiry plays in this. So I just tend to ignore the third week of the month in America in terms of being an indicator of what to expect in the next month or so, because it can be just a bit of an aberration. Silver also looking similar, so it's just been flicking above and below this key $30 support and resistance level. And if we look at GDXJ on a daily chart, you can see it's definitely an uptrend. There's no question. The moving averages are all heading up. We're forming higher highs and higher lows. So there is a positive trend, but we're starting from a point where gold and silver stocks relative to the price of the underlying metals are at multi-decade lows. So there is the potential for this to really escalate. But my view is that you still need to be buying the best of the best, and that can be largely around the asset that they've got. It should be a world-class asset that's in demand that others want to acquire. And don't underestimate the value of the management team. So I think if you do those two things, if you look for world-class assets being run by a management team with a great track record, then I think that gets you a long way to being successful in that part of the market. Other commodities, copper was down to 4.23, quite a strong slide. Nickel, 7.26. West Texas Intermediate crude was down a little bit, 82.2. There are some concerns over China demand, but again, there's always lots and lots of cross currents and ups and downs in the energy market. There's the spot copper chart, so you can see how much it did fall in the last week. Crude oil also eased back down again. So wrapping it up, the outlook for commodities under Trump policy is probably going to be more positive than negative. There is almost certainly a rate cut cycle about to start, not just in America, but also in Europe. And it's also highly probable there's going to be trade wars. And that can cause all sorts of unintended consequences, but it's probably going to be net positive for precious. Don't know what it'll do to the copper price, to be honest, because the copper price is sort of defying logic at the moment. It really should be higher given the long-term supply and demand outlook, but whatever factors are holding it down, under Trump, it's almost certain we're going to have uncertainty. Is probably the most certain thing that we're going to have, given the way that Donald Trump functions. So the key with commodities is how to deal with that uncertainty while benefiting from the large winners. And there are, and there will be. So again, it just gets back to clarity around plan. Portfolio analysts last week, we looked at avoiding the bad losers. The week before that, we had focused on how to make the best out of the terrific winners, the terrific long-term wealth compounders that are out there. Avoiding the losers is the other half of that equation. So we looked at that last week, and also my favoured gold stocks. That's it for this week. More on the website. There's my email address. Be back with you next Sunday. Cheers.